Is this thing on? We live. What's going on, party people out there on the interwebs? I'm posting reels now, trying to be cool. Do what I can, do what I can, do what I can. This will be a pretty quick video today. I'm going to run through where interest rates are at. We're going to take a look at a couple of things. Financial markets, super weird, right? I mean, when we look at what happened, let's not look at that one. Let's look at the S&P right here. And let's zero out a little bit. Remember, we were looking last week and I was telling you, listen, the S&P is doomed to come back down and get to this area. It's just doomed. And then look what happened. 2 days in a row, huge bull moves higher. These are just sort of typical bear market rally situations. And it's always when you least expect it. That's why I always say, financial markets can always go both ways, no matter what's going on. No matter what, they can always go both directions. Always be prepared for it. Here you can see we just come up to the 382 on the Fibonacci. So good chance we see a little pullback tomorrow, especially after this huge run. These last couple of days have been absolutely massive. I mean, what was the Dow's up 825 points today? That's crazy. 825. And that was on the heels of a huge day yesterday as well. So things got pretty ugly, at the end of last week. And, it looked really bad. And sometimes when things look really, really bad, when they look the worst, is when you kind of expect things to go the other direction. The Fed, however, is causing problems. And what we discovered last week as we were researching this is there's derivatives, there's credit default swaps, there's leverage that's being used against safe assets like bonds. This is what happened in Europe, or I should say in England. Safe assets like bonds were being used as collateral to borrow money to go do risky stuff. There's some weird things that can happen in financial markets, and you don't really see it. It's all done behind closed doors. It's not transparent. You don't know what's happening. Well, with the Fed, what they're doing, everything they do is transparent. We do see it. We don't necessarily see it in real time, but we get reports of it. Here's the thing, probably the most important article to read that I've ever posted. This is called "The Fed is Breaking Things." Here's what has Wall Street on edge as risks rise around the world. Why are risks rising? Well, because number one, what happened was a lot of people believe, like I did, that the worst of inflation was behind us. So a lot of big bettors got on that side of the trade. They got on the side of the trade that, hey, inflation's behind us. Well, when we got that inflation number last week, that wasn't ideal, little uptick, not much, tiny uptick, but an uptick nonetheless. It caused a little bit of panic and liquidations across the board for those bets that were made. So that's what caused the falls below support. It fell below support on bonds, fell below support on stock market indexes, a number of different things. And so you saw this capitulation that took place. On top of that, check this out. Okay, so last week, statistically unusual moves across asset classes became commonplace. Very true. Very, very strange moves became common. Why? Because people don't know what to expect. Don't know what to expect from the Fed. Don't know what to expect from inflation. The market kind of thought it had things figured out. That was usurped. So surging volatility and what are supposed to be among the safest fixed income instruments in the world could disrupt financial systems plumbing. That's the bond market. Okay. The bond market is supposed to be the safe place to put your money. It's supposed to be low risk, almost no risk, low return, but almost no risk. And we saw wild fluctuations. Mortgage bonds affect interest rates. That's why we saw rates go up so much. Lots of volatility there. Okay. That could force the Fed to prop up the treasury market. Doing so would likely force the Fed to put a halt on its quantitative tightening program ahead of schedule. So this is why we're up yesterday and today. It's becoming more and more apparent that the Fed's actions are having repercussions that are far and wide, much further and wider than expected. And inflation doesn't really seem to be as big of an issue if you look on a global scale. I mean, look, here's the dollar. Now we have pulled back. Okay, we have pulled back from this high here, but look, we're still in this channel, and very likely, as we have in the past, off of this area, we're going to bounce. These kinds of deep pullbacks in rising channels are the best opportunities. So there's a good chance that the dollar continues to strengthen from here, unless the market believes that the Fed is going to put a halt to this quantitative tightening. Very well could be the case. Let's look at, and then here's the other worry is that that's whipsawing markets will expose the weak hands among asset managers, people capitulating because they're weak-handed, they don't really know what's going on. Other players who may have been over-leveraged or took on unrealized risks, margin calls, and forced liquidations could further roil markets. So there's a lot of uncertainty. This uncertainty is causing some panic. It's causing some problems amongst different asset managers, hedge fund managers, market makers, people who are moving big dollars around. They can really move these markets if they're on the wrong side of the trade. And that's what we saw the past couple of days. However, this has worked out for us when it comes, let me get a refreshed chart here. When it comes to mortgage rates, which have dipped about 0.25% the last couple of days. If you look at the link we use here, this is starting to get further and further from accurate, at least with respect to what I have. So like my FHA and VA rates are not 6.5. We're in the like 5.75 range. Now I'm always lower than these rates because these are like average rates, but I mean, we're way lower on those. So what that tells you that there's a lot of banks that have not quite gotten things figured out yet, or they're still over leveraged expense wise, and their rates are higher. And that's what's tilting the scales and sort of balancing things out as the averages being much higher. But what we did get, even though it's a red candle today, we got what I finally called for a few days ago, maybe a week ago, which was a return to this level right here. We finally got there. Actually, I think it was after we got this candle and then this one. And I said, hey, we're going to make a run up to this guy. That's almost guaranteed it's coming. It took 1, 2, 3, 4 days to get there, but we got there. So we bounced off of it. It's resistance. That's fine. It's okay. We're going to get to these levels and bounce off of it. Notice the tight, small candle here for mortgage bonds. Remember, we want mortgage bonds to go higher. The higher these go, the lower rates are. The lower these go, the higher rates are. So we want to see higher prices here. And we've got a nice movement in the right direction. It's not a lot yet. It's nothing to go right home about, but it's something. By the way, we're live on Facebook, LinkedIn, YouTube, Twitter. One of these days, I think Instagram is going to be on there. I think they're going to work that out. But right now, we got what we got. So drop a comment or question if you want to say what's up, and I'm happy to oblige. All right. So we have some things happening that are good in the bond market. We have some things happening in the financial markets that are happening that are bullish. But as I said, we're right up against that 382 here. And so, I mean, that's a tough place to close as far as what's going to happen with stocks in the coming days. However, what this has done is has created new support down here, which, we'll see what happens. But we're still overall in this bearish horn. These two blue lines here showing the bearish horn. And so we really need to go sideways and kind of get through that over here. So we got a long ways to go before we can get there on a daily chart. We're kind of in this mess for a while now, at least to the end of the year. We're going to be in this thing most likely. So it just doesn't look great for stocks, which should be good for bonds if the bond market isn't broken and if the Fed would stop breaking things. Can you guys please stop? Anytime? And now there's a lot of things the Fed could do. If they do start to buy treasuries, which is what they're talking about here, prop up the treasury market. That's what that means, buy treasuries. Then that would also affect mortgage rates, cause mortgage rates to go there. Can you imagine if that started happening? First of all, if the Fed just says we're going to stop tightening, in other words, no more raises, no more hikes for now, we need to let things settle. We've done too much. The markets are confused. We need to let things settle for a second. The inflation isn't that bad. The dollar is very strong. Okay. If they just did that, you would see mortgage bonds skyrocket. You would probably see the stock market skyrocket. I mean, this thing is just like kindling a little fire from the Fed, and woof, it wants to go up. But the rule on Wall Street is you never fight the Fed, and the Fed right now is pointing to lower prices for assets, and that's why you're seeing the market kind of get dragged that way. There's also some stuff, Credit Suisse. So Swiss Bank, Credit Suisse, huge bank, credit default swaps on this bank traded at extreme prices, meaning that people were betting on its failure in a major way just this past weekend. So they also had some calls with some of their big investors, some of their big account holders. There were a lot of issues there that made people go, oh, this bank's going down. They're done. How crazy is that? No real sentiment, not a bad quarter, nothing like that, just whispers. And everyone's like, they're going down. And so credit default swaps, betting against in a major way, the bank. And the bank has come out and said, hey, listen, we're going to report our earnings early this month just so people shut up. So that was like a false flag, but it was enough to get markets to capitulate. So when you see stuff like this, a lot of times that's what it is. It's like a false flag that gets weak-handed people to go, oh, it's all going to hell. Sell, sell, sell. And they get out. And then they go, wait a minute. And the market rallies huge the next 2 days. I've been that guy before. I'm not laughing at you. I've been that guy who sold like, oh, it's all over. Sell. And then the next day, up 80%. That's happened to me. So I know what that feels like. That's what it is. It's to get the weak-handed people out. There was nothing real to this. They're going to report earnings early. If they were in real trouble, they wouldn't be doing that. They did say, hey, listen, we're looking to raise money. We're looking to cut. What bank isn't? What bank isn't trying to woo big dollars in? That's what they do. Come on. I mean, this isn't rocket science. You know what I'm saying? There was one article here I want to share as well. 3 major ways debt can affect your ability to buy a home. Look, when you're looking at this stuff, debts do affect the way your ability to buy a home. Sometimes car payments can get in the way for people, but you do want a car loan for the sake of your credit score. Let me just tell you what they said here. So it shows lenders you can handle. Having some debt on your credit report is still really important. Lenders need clues. Yeah, you do want to have some. If you have nothing on your credit report, you probably don't have a credit score, and that becomes a problem. If you have credit card accounts, don't close them. Pay them off. Use them once every 6 months, and that'll keep them scoring for you. Okay, so just use them once every 6 months. Like we use our credit card for everything, get points for Southwest. I don't use debit for anything anymore. And then we just pay it off. Managing debt well, really managing debt, what you need to do there is keep your credit card balance as low as possible. Remember my number one hack for that. This is huge. Number one hack, credit card payments. If you're going to pay your credit cards off every month, pay them off before the statement ending date. If you pay them off before the statement ending date, then the reported balance to the credit bureaus will be 0, and therefore you'll actually get credit for paying it off. So keep your credit card balances low, and ideally manage to keep an auto loan, even if it's a small auto loan. If you just like, I just paid off my car, man. What are you talking about? I'm on the Dave Ramsey thing. Listen, it's great if you can live in a cash world, but if you need to borrow money, you're going to want to have a small car loan, even if it's $1,000, $2,000. Doesn't matter what the amount is. Doesn't matter what the payment is. It will help your credit score if you have one. Having too much debt can make you ineligible for home loans. Totally, obviously. So managing debt, keeping debts low, this is all helpful. But when you get pre-approved, we can go through that with you, show you everything, explain it to you, give you what your options are, tell you how to make a roadmap. All that stuff is super doable. It's really, really easy. It's not complicated. I'll put my information on the screen. You can get a free loan quote from me anytime. We charge no fees. How we beat these rates up here that I show you every day, that are the average rates across all websites that are tracked here. We beat those rates. We don't charge any fees. Call, text, shoot me an email, and I will hook you up like a tow truck. Let's see here. The webs. Bag holders of Archeos Capital. They are the bag holders. I won't get too much into that. Dan Maurer, what's up, Dan? Any update on cash out options? Yeah. I just ran cash out options for a investor who is basically doing investment property cash outs. He's got himself in a great position, purchased a bunch of properties really well. And, you can go up to 70% cash out on these investment properties. Rates are mid-7s with good credit. Assuming you see single family homes, good credit, mid-7s is what you can expect for cash out options there. Yeah, I do expect those to get better. I definitely do expect those rates to improve along with all rates probably over the next 12 months. I'd say by the end of next year, we'll be looking at a totally different market. So let's see what happens. Good stuff. Thanks, Dan. Appreciate it. All right. So we got some movement today, 20 basis points increase for mortgage-backed securities. We have a nice little channel getting started here, moving higher. If we can get up to this first moving average here, that'll be the real test. And if we can beat that, the next piece of resistance is kind of far away. So I like the possibility of a move here, especially if we go back to the DXY. This is the dollar right here. Red arrows are where we have seen rate increases from the Fed. They're just marching this thing higher. And now we have a deep pullback. This deep pullback is not the first time we've seen it. We've seen a couple here. They have always sort of come to fruition and stayed within this channel. So I wouldn't be surprised if we do bounce off of this. Maybe we go a little bit lower. But if this does break down, okay, if this breaks down, everything's going higher. Remember, this means if the dollar goes down, everything priced in the dollar goes up relatively. Got it? So when we're looking at, let's say the S&P, this is per dollar, right? This is $3,790. That's the sum of the stocks, right? The way that they calculate that index. So this is all done in dollars. Every stock that's a part of this index is priced in dollars. Same thing with crypto. Notice today, Bitcoin broke above. And when we last looked at this, it was just like doomed. Bitcoin had broken below, this upward trend line here, broken down, but we were at support, but it broken down below the trend line. And then 2 days in a row, right up here to the 50% retracement. Just look at that. Look how pretty that is. Just touches it right on there, right on the money. So money. It's Fibonacci's. So goes up, touches it. Now, will it continue to bust through? We've got this downward trend line here. If you see the dollar, if the dollar comes back, you're going to see cryptos go crazy. If the dollar breaks down here, goes lower because the thought of the Fed maybe not raising rates or maybe getting a little dovish, this breaks down, cryptos will run. So will stocks. Everything will go up. It also should cause bonds to go higher. So even if the Fed doesn't do anything, just the thought they might can make the markets go nuts. And that's what we're seeing. It's not a bad thing. I will tell you this. A lot of people there's still a lot of real estate activity going on. I know the numbers don't look terrific from the standpoint of, hey, this is what rates are. A lot of people still looking for homes. A lot of people still getting pre-approved. A lot of people still kicking tires. There's still a lot of activity. We don't have that kind of crickets type situation, even though I don't have a lot of loans going on at the moment. I have lots of time to help you if you need me. There's still a lot of activity. The rubber's not really meeting the road as much because people aren't in love with the payments they're seeing. So they're being more picky. Buyers are being more picky. They want to make sure it's the perfect one. If I'm going to pay that much, it's got to be perfect. The house has got to be dialed in, and we got to get everything we asked for. If they're not getting that, they're not buying it. They're not in. So the market tightening right now, getting a little bit more advantageous for buyers. People say, but how can you say it's better for buyers? Why are all the buyers scattering if that's the case? Because the price that you pay for the home is permanent, right? We always say you date the rate, you marry the house. The price you pay for the house is permanent. That's it. That's where all the calculations begin. But the rate, that could change. People refi on average every 4 years. On average, people refi every 4 years. And that includes averaging the people who never refi. 4 years. So, but that price you have to stick with forever. So yes, it's better for buyers to be able to get a lower price and higher rate because then they have upside. They have the ability to get a lower payment on that home down the road. And if rates just run away, then hey, at least they got that rate and not a much higher one, right? So rates being up, although it is annoying and although it gives sticker shock to some of these payments, it actually is better for buyers. It's bad for sellers, right? And if it's bad for sellers, it should be good for buyers. That's one way to look at it too. So let's see. So talked about, all right, the DXY, cool. All right, so here's what we're going to do. We're going to keep a close eye on this for tomorrow. Going to be a very interesting couple of days. Trying to do reels and shorts now. If you follow on social media, reach out to me if you need help with anything. 2 days in a row, I've heard from people on YouTube who need help with a loan. Happy to help you, your friends, your family, anyone who you want to get hooked up like a tow truck. You know where to send them. The no-fee guy, wholesale rate guy. Boy, Derrick's here. Email me, call me, text me. I'll be here for you when you need me. Have a great day, team.